right, good. Everybody come on in, say hi. Appreciate it, Chris. Tell us who you are, where you're from, what city you're coming in from. Appreciate everybody coming in. All right, so today we're going to talk about multifamily cap rates. This is a kind of a interesting conversation and a bit of a difficult topic. Um, Takes me a little while normally when I'm teaching this to kind of get everybody to understand cap rates. So I'm going to give you a breakdown of what that is today and how we use multifamily cap rates. All right. I'll start off by saying cap rates are like a multifunction tool, right? They're like a Swiss Army knife. They do a lot of different things. They just don't do any one particular thing very well, right? So cap rate is not something you want to base all of your buying and purchasing criteria on. It is a metric for valuation. It is not the metric for valuation. It's just one of. So we don't want to get stuck living and dying by cap rates. All right, cap rate functionally is the price or value divided by the net operating income, or net operating income divided by price value. So price and value are not the same thing. So be careful about that. And this is where the conversation about cap rate already starts to take its first fork in the road. What are we talking about here? Price or value? So we're saying it's the ratio of net operating income to either price or value. Okay, price is what we're paying for something. Value is what something is worth. Hopefully, we're paying less than value. So when we first sit down and start doing our underwriting and we are going on the seller's asking price, and we're saying, here's the asking price, here's the net operating income being generated by that property right here, right now. That is the NOI, or the cap rate generated by price. Okay, and that's our purchasing cap rate. That's one of the first things we're going to do when we sit down and underwrite a deal. What is the cap rate? Well, now think about this. This is again where I mean these kind of multifunctional tool thing here. Whose number are we using? When are we using this number? With what data? All dictates the cap rate. And so it's almost like it's in the eye of the beholder, right? It's almost in who is doing the math. So see here, I'm buying a property and I'm paying, let's say, $1 million, whatever, and that's a 6 cap rate. Okay, fine. That's the cap rate I'm buying the property at when I enter. It's not the market value cap rate, right? It's just what I'm paying today. Now let's talk about cap rate in the simple use of cap rate. It is a fast metric for us to gauge whether we are paying more or less than everyone else in the market, right? Layman's terms, that's what cap rate's for. So what we're saying is if I'm coming in, I'm looking at a deal and my $1 million purchase price that I'm describing here gives me a 6 cap rate, and everybody else in the market is paying an 8 cap rate for the very same type property, I am paying more than everyone else, right? It's an inverse relationship. As cap rate falls, I am paying more for the same stream of revenue, NOI, produced by a multifamily property. And that's the use of cap rate right there. It shows us how buyers in a market value a stream of revenue produced by a multifamily asset. In my example here, if I'm buying that property in $1 million, that gives me a 6 cap rate, but everybody else is an 8. I'm paying more. And if everybody else is paying a 4 cap rate and I'm getting to buy that thing at a 6, I'm paying less than everybody else for the same stream of revenue. So when we see market, as we've seen over the last 7 or 8 years, cap rates declining, that is meaning that at every sale, someone, the next buyer, is paying more for that asset than was really generated by an increase in cash flow or NOI, right? And so that's cap rate compression over time. And if we look at the multifamily market cycle over the last 10 years or so, well, 20 years really, cap rates have been steadily falling. Now they kind of decompress for a while after the '08 cycle, and then they just go right back down to compression again. And so if we follow that concept all the way out to fruition, we're essentially saying cap rates are going to go to 0 in the multifamily market. I kind of doubt that, right? Because we're saying then that nothing will ever cash flow. And I don't think America is ready to trade the average multifamily asset without any metric of cash flow. I'm not saying that all real estate cash flows and that all multifamily will always cash flow. Not true at all. Look at assets in New York, LA, Miami. There are different markets where they are very high value assets that do definitely go up in value. Money is made. It's just a very low cap rate asset and therefore probably does not cash flow. So that's where we're looking at. Cap rate is that snapshot as to, are we paying more or less than everybody else in the market? As cap rates fall, we're paying more. I think we're about to go into a cycle of decompressing cap rates, especially when we start talking about older assets, 1960s, 1970s product. I have several clients right now that are trying to sell a few of these assets. Market update. Offers are all coming in around an 8 cap for these 60s and 70s built product. And that's pretty tough because a lot of those properties were bought at 4, 5, 6 cap rates, and now buyers are wanting to buy them at 8 cap rates. Why would these cap rates decompress so much so quickly? Interest rates. All right, so let's go this route. And I've done a lesson on this, I think it was about 2 weeks ago. What happens when interest rates are higher than cap rates? Well, the answer to that quick question is the asset does not cash flow. You're not going to make any cash flow. So when we're looking at cap rates in the market, and you're saying, per this math, it's a 5 or 6 cap rate, whatever, and interest rates are at 7 or 6.5, 7, then day of, that asset is not going to cash flow, and you're going to need to decompress that cap rate as soon as possible. All right, now that takes us into a whole nother use of cap rate. Now we're going to talk about pro forma cap rate and operational cap rate, not just purchasing cap rate. So you would have a purchase cap rate, a pro forma cap rate, an operational cap rate, and an exit cap rate, right? And we're going to talk about all those, but that's why I'm saying it does so many different things. So if the interest rates are above cap rate, you're not really cash flowing. And this is how everybody got in so much trouble over the last several years when interest rates were very low, sub 4%, sub 5%. You could go out and look at an asset at a 4 or a 5 cap rate and then put into it a little bit of rent increase or value add or something like that. And on paper, that product looked like it would make money, right? And that was because you had this 2-year interest only, low variable rate kind of loan, and it made sense on paper until the interest rates went up. And then what happened was the interest rates greatly started to exceed cap rate, and the loans have matured, and now there's that inversion in value, and that's due to the decompression of cap rate, which happens with interest rates. So we have to be very careful in our underwriting when we're underwriting deals like this. All right, so let's talk about operational and pro forma cap rate. Best described by a deal that I did, actually the property that I met Monica on years ago in Warner Robins, Georgia. It was a great asset. I tell this story a lot. When I went in there, I bought this property at about a 2 cap rate, right? 1 cap rate, I don't even remember. And so everyone would say, gosh, that's a horrible deal. No, not enough information is what I would tell you. And this is why I reiterate that cap rate's not enough info to live and die by. Low cap rates can be very good deals sometimes if we have a clear path to decompression. All right, so I find this property. It was 196 units. It was at 60% occupancy. Okay, there's the hook. When you think about cap rate, it was the seller's price being in the cap rate being generated by the NOI at 60% occupancy. So obviously that was a very low cap rate, not enough information. Why was the property at 60% occupancy, right? That's what we really needed to look at. And so I looked around and realized that the neighborhood is great, and it was just a little old fellow that owned it free and clear for a lot of years, just mismanaged. Long story short, Monica and I take over. We go in, we turn the operations around, we decompress the cap rate. So remember, I've bought the property here. I forgot what it was, $4 or $5 million, something like that. And I'm decompressing the cap rate by raising the NOI. All Monica and I are doing now is leasing up, right? We're filling units. We're bringing the occupancy up. The NOI is decompressing. Cap rate went from a 2 to like a 12, I think, in about 18 months, less than 2 years. And then we recompressed at a 7. So I bought it at a 2 and sold it a 7. And you would think, wait a minute, that means I lost money. Well, in theory, if I bought it at a 7, changed nothing, or bought it at a 2, changed nothing, and sold it at a 7, you're right, I did lose money, but I didn't. I bought it at a 2, decompressed through operations to the 12, then sold at a 7. And see, so now that's my going in cap rate was very low. Then I looked at my pro forma cap rate, and I sat down and said, okay, yeah, the property's at 60% occupancy today. What if it were at 95, like everybody in the market was, like everything was? And I did that math, and I said, oh, if I can get the property to 95% and my purchase price is still, what I'm buying it for, that cap rate explodes, really. And that's how I knew that was a fix and flip. That's how I knew that was an excellent deal to go in, renovate, do the BRRRR model, buy, renovate. We sold it. We didn't refinance it. I actually regret that. Sorry, Monica. I wish we'd have kept that property. I know you don't, but I wish you were still running that for me, and we still had that asset. Life was good. But anyway, so that's kind of the decompression of that cap rate and then a recompression at sale. Now, the buyer walking in sees the asset at a 7 cap rate, not a 2 cap rate nor a 12, because that's their buying cap rate. And of course, I'm sure they had their own pro forma, cap rate, so forth, so on. But that's essentially how you need to be looking at cap rate. It's a multifunctional tool. It is not one size fits all. It is usually not giving us enough information to really fully underwrite a deal. It's an aspect of underwriting, but it's not the aspect. You need to understand that there are different arrays of capex or cap rate. You have your buying cap rate, right? Then you can create a pro forma cap rate. Sure, I'm here, but it's going to go to here. You're going to decompress the cap rate over time. All right. So that's value add, and that's what we're all doing in today's world. Think of it this way, though: if you are buying an asset at a low cap rate, you are technically going to work for the seller for a while, right? As I did by buying that property at a 2 cap rate. Yes, I went to work in theory for the seller for a little while because I had to recover the value of that property. And so look at it like a low cap rate is almost kind of like starting a foot race, about 10 feet behind the starting line. You've got to get running just to get the race started, then to make value. It's like starting in a hole in the ground. You got to fill the hole up just to get on level ground, then to start to see actual profit and value. So be careful about low cap rates. I will double down on that comment about low cap rates if you are looking at an older property, 1960s, 1970s built. That is not a 4 cap, that is a foreclosure. Be careful. You're going to get in trouble buying those things at really low cap rates. You buy something older with a low cap rate operationally or going in cap rate, your operational cap rate may be considerably lower if you start having things break, the plumbing, the roofing, the electrical. You've got to go do upgrades you weren't planning on, this, that, and the other. So that's where you've got to understand cap rates. You have to understand that it is just a marker of what everyone else in the market has done and is currently doing. So I would say in the market cycle that we're in right now, what you want to be looking at is cap rates and saying, well, that's definitely what I'm not going to do. Whatever the historical cap rates are, don't do that. Do more than that, right? I'm telling realtors now, as I'm looking at deals, I say, well, what are comparable sales? And they'll say, oh, it's these. And I say, well, good. Comparable data is just telling me what not to do, right? Comparable data is just telling me what not to pay, because I'm telling you what everybody else already paid was wrong, and you want to pay less going forward. So tell your realtor, Bill said, comparable data is, what we're going to go on to not pay, not to pay, right? Difference these days. And that's what you got to watch out for, right? The market's in a downshift. That's due to interest rates going up. You just got to watch underwriting. It's a great time to get in. It's a great time to buy. You just got to know what you're doing. I see we got some comments and questions. I'll take them over here in the corner here. Before we get into that, couple of announcements real quick. Monica has brought us a newer version of the ultimate underwriting template. It's new, upgraded with some new features that is going to be available on the website for download. So please go over to realestateraw.com, check that out. And I am also going to be running a webinar coming up in a few weeks on underwriting. So stay tuned. We'll give you some more details on that. But I'm going to be doing a big webinar, hopefully about 3 or 4 weeks now. We'll get some advertising out for that. So everybody get signed up. Going to be a whole night on just math, underwriting, and underwriting deals in today's climate. So, all right, let's take a look over here. Yeah, Monica says we can buy that property back and still the market. If we could buy it back for what I paid for it, I would absolutely take that property back. That was probably one of the most profitable properties I've ever owned, at least in the sense of cash flow. Did have some capex issues, but everything does. I would have kept that thing all day. We should have refinanced that one. That's one that I will say that I'll regret. Everybody here, what I should have done was refinanced this property, bought all of my partners out because most of my partners kind of wanted to sell and go on. I should have refied, given them the cash, bought them out, kept that asset. I would have been in there alone, sole owner. I would have had Monica running the property. Life would have been great. So yeah, that's my regret. know when to slaughter the golden goose, know when to keep it. All right, Michael, how were you able to get financing at 60% occupancy? Ooh, good question. I'll explain that. Most traditional financing. Okay, stop right there. Bridge, hard money loan, bridge. I did not get traditional financing. Yeah. So Michael's absolutely right. So for traditional financing, first comment, you're likely to be held to a 1.25 debt service coverage ratio. And as Michael points out, most people want to see about 90%, most lenders want to see about 90 for 90% occupancy for the previous 90 days. Yeah, interesting loan here. This was actually, what was that from? I have to remember who it was now. It was sort of a boutique lender. They were not a traditional loan. It wasn't quite a hard money loan. What this lender did was they came in and they said, we're going to give you a floor interest rate. I think it was like 7. And they started the deal off at like 10% interest rate. And they said, hey, but it's going to be a floor of maybe 6.5 or 7, something like that. And what they said was they will bring the interest rate down from the 10 to the low of 7 when I get the property to a 1.25 debt service ratio. So they kind of put a carrot on the stick. It was an interesting loan. It's the only one I've ever done like that. But interest rate started at 7, and as we performed, as Monica leased that property up, and I was able to show this lender stabilized operations, they lowered the interest rate. I believe, if I remember, we came out to about a 9% blended rate on that particular deal. But again, it made tremendous amount of money because it was such a good deal. But yes, the financing was definitely non-traditional, and I got a $400,000 carryback by the seller. So $400,000 seller financing, carryback, second mortgage, and that sort of almost hard money loan, kind of a firm money loan there from that commercial lender, but aggressive deal. So you're absolutely right on that one. All right. Knowing what you know now, would you go back in time to the 2 cap and change the purchase structure to an MLO or other? No, because I'll be honest, not to say, Ryan, that that's not a good idea. I didn't need to do it. I was able to get that property at such a cheap price that I wasn't going to try and carve that thing up any further. I realized what it was. I realized the value in it, and my partners and I had the money to do it, so we just went ahead and bought it. Sure, it would have been nice if it was an MLO or something like that, but didn't need to, and I did get some seller financing on that. Would I recommend that when viewing a property like that, you consider seller financing a lease option? Absolutely. Yeah, definitely. But then again, sometimes good deals are just good deals, and you just got to jump on them. We even though it was in theory a 2 cap rate, I'm telling you, we were buying that property at an absolute steal. I think we got it at like $35,000 a door. I don't know, Monica. Any idea what it was trading for recently? Like 80 a door or something, So we got it at a pretty good price, and then really renovated, made some great cash flow on that property. Hated selling it. After you refinance, Anthony, he said after you refinance that property, do you think you would have sold that off for the rest of your portfolio a couple years ago, or still hold on to it? Yeah, actually, I never thought about that. That's a good question. Anthony's saying would, even if I had held on to it, I still had another the rest of the portfolio that I held on to until a year or two ago. Um, yeah, I probably would have wound up selling it. Nobody ever went broke cashing checks, so I'm kind of a bird in hand guy. Anthony, I probably would have sold to answer you. Yeah, the market would have gotten up. I would have seen the writing on the wall. Somebody walked in the door and offered me a big check, and I said, screw it, you can have it. So probably would have sold it. Yeah, I just wish I would have held on to it longer. We would have cash flowed much more, and our sale would have been better later. Again, I was a little concerned about the market. It had been going long at that point in time. So I was probably paying a little too much attention to market cycles, drinking too much of my own Kool-Aid at that point in time. So gotta be careful about that stuff. Never try and time the market. There's no point in that. All right, we probably would have kept 2 or 3 of them. Yeah, I agree with Monica. That was a good property. There's a couple of them we probably should have kept that were decent ones, but that's here or there. So yep, if you get a hold of a good asset, I really truly believe long-term hold and operate is the right strategy. Yes, but comma, right? You have to have the debt and you have to have the asset that'll allow that. But if you can buy and hold, I think that is the best long-term strategy. Again, you need a loan that'll allow for that, and that's a whole nother conversation. but maturity exposure is incredibly important if you plan on holding assets for long periods of time. You don't want to be out here getting these 2-year interest only bridge notes and garbage like that. You need assets that you can get agency or long-term debt on so that you have stabilized loans. Number one. Number two, you need a building that's not going to kick your teeth in with capex, right? I mean, you need to be able to sleep at night and know the plumbing's not going to explode. So those are the big areas that I would say if you can get a good property with a good loan and it will cash flow and operate, then the only thing left you need is a Monica. You find yourself a Monica to go over there and really make your life easy on operations, and then you're home free. But yeah, if you don't have a Monica, then I really suggest that you be careful about what you buy, because you're going to have to go out there and hire management, or you're going to have to manage it yourself. And you want to set yourself and your management company up for as much success as possible. One of the big mistakes I see is people going out and buying just junk real estate or really old building in a really tough neighborhood, really high crime. They turn it over to a third-party management company, and they can't imagine that they're not just living at home, soaking up all the cash flow, and they can't figure out why. There's some properties, some areas that it just doesn't matter who you hire or what you do. They're going to be tough to manage, right? So set yourself up for success. Newer buildings, good loan, hold on to these things into the down cycle, going into a recession cycle. You're going to come out the other side with some really, really good assets, and you'll be doing well. If you really try and get speculative, short-term hold flips, things like that in this market cycle, you might get yourself in a little bit of trouble. So, but that's cap rate. We're seeing cap rates decompress back to that. So go ahead and try and purchase ahead of that decompression. Obviously, easier said than done. I understand sellers are not capable nor willing to sell at high cap rates right now, but sit tight. I think we're going to see an absolute shift in decompression in the market. Seeing a lot of operational distress out there right now. Seeing a lot of issues behind the scenes. If anybody has any comments or questions about operations, certainly let us know. Monica and I have a lot of years between us in management and operations. If anybody behind the 8 ball, if you need any help, perhaps you need someone to talk to your bank for you or something like that, reach out to us. We'll be happy to help you out. If you have any questions, she and I are both available. You can just IM us here. Excellent. Thank you for stopping by. That's what I have for you this week. Again, check out our new template on the Real Estate Raw website. Got the update there. Excellent template. I'm super proud of Monica for creating that, and thank you to her and her sister for building that for us. Really, really good template. If you already have it, we'll be sending you an updated copy. If you don't have it, go grab a copy. Look for the webinar coming out in a couple weeks. I'll give you some update on that, and we will see you next week. Take care.